Hey guys, I'm going to shoot a video today on one of our products. It seems to cause a lot of confusion. Hopefully I'm going to make it pretty simple for you guys. And the product I'm talking about is the mortgage acceleration product that we have. And this one thing people say, it's too good to be true, it doesn't make any sense, why have I never heard about this, why didn't the banks tell me about this? And the truth is, this is one of the single most powerful things someone can do to take control of their finances, their financial picture. Okay, instead of giving all of that money to the bank, they can pay off the home early and use that money to provide for their family, to build their retirement. And they're going to have some questions. They don't simply understand the mathematics. So I'm going to share the basic, simple mathematics with you. This will be a perfect scenario, but it's still going to be very simple and very self-explanatory. Okay. So when I sit down with a client, the first thing I need to do is kind of introduce the basic principle of what it is we're doing. Okay. And that is offset accounting. It's using your income, instead of letting it sit around in the bank, do nothing except make money for the bank. It's how we can use our income to cancel the interest that we pay. So let me explain the concept in a very simple illustration here. All right. Let's say I have a $10,000 credit card balance. Okay. The bank's going to want a 4% payment. So if I pay 4%, that's $400. For sake of example, we're going to say $200 goes towards interest and $200 goes towards principal. So I've got a $10,000 credit card. I paid 4%. My balance is now $9,800. Okay. So how can offset accounting help us pay off this credit card balance? I don't have any extra money. How do you expect me to pay off this off sooner? Well, let me show you. Okay, so we're going to start with the same $10,000. We're not going to change the amount we pay. We're just going to play with some numbers here and put our income to work for us. So let's say that my monthly income is $5,000. Got it? So what I'm going to do is I don't have any extra money. Every dime I have is going to go away. But I know that I can make a $400 payment against this credit card because that's what I do every month. So now, what's going to happen is I'm going to put my entire income against this credit card balance. Now, when the credit card company goes to charge me interest, what can they charge me interest on? $5,000, right? So you can say, you know what? We want a 4% of $5,000 is $200. Again, 100 of which is going to go towards interest, and 100 of which is going to go towards principal. What I'm going to pay is the same payment I was paying before. I'm going to pay $400. So they're going to get an additional $200 from what they're expecting. So I'm still paying $400, but now they can only charge me interest on the $5,000. I've added an additional $200 toward the principal. So now when I make this payment, my balance is $9,700 versus $9,800. Okay? I didn't pay any more. I paid the same $400. What I did was use my income to offset the interest due, make the same payment. It's more effective. Now, this is month one. Imagine how this process would work if we repeat it, okay? That is the magic, or the mathematics, if you will, of offset accounting. So the question is, how does offset accounting work with my mortgage? Well, let's talk about that. Now, the first thing we need to do is understand how a traditional mortgage works, okay? And if you have your amortization schedule, if you have one, I advise you to take it out and take a good look at it, okay? So when you have a traditional mortgage, kind of one of the things that people don't understand is this. First of all, people need to understand how much they're going to pay in actual interest. If you have a $250,000 mortgage, and again, I don't have the math with me, but this will be very close, okay? And you have a 4% interest rate, which sounds really good. You're probably going to pay back about $215,000 in interest. All right? That's another house, basically, in interest. All right? So when you sit down with the homeowner, have them take out the paperwork if they can, or prepare it for them. Hey, I took an amortization schedule, I printed one out, this is your home on a 30-year mortgage at 4% interest rate. This is what you're going to pay in full interest, okay? Make sure they understand how terrible that figure is, all right? Number one. Now, why is the interest so much if the rate is so low? Well, here is why. On a $250,000 mortgage, I can tell you the P&I payment is pretty close to $1,200 a month. All right? And it looks a lot like this. Payment number one is $300 principal. It's $900 interest. The next month it is $301 principal, $899 interest. If you don't believe me, look at the amortization schedule. Usually it changes by less than $1 per month. It's frightening. All right, next month, $302, $898. And this is why it takes so long to pay off a mortgage. Now, here's what this means. By moving these pennies, let's say for sake of our example, all right, to gain $10,000 in equity, and this is all approximation, I don't have the actual amortization schedule with me. Well, let's say it takes you 3 years in payments, and this is pretty accurate, folks. So, to get to $240,000 in equity from your payments, you paid 3 years in payments, $1,200 a month. That's basically 36. That's 36,000. We're going to call it 43,000. I think that's pretty close. You paid 43,000 to gain $10,000 in equity. You paid $33,000 in interest to gain $10,000. And guess what? Most people are in their home for 7 to 8 years. So think about this. You pay $60,000, $70,000, something thousand dollars, about $75,000 to gain $15,000 in interest. In equity. That's pretty frightening, right? That's a great deal for the bank to lend you $250,000 for 7 years, and you're going to pay them $60,000, $70,000 in pure interest. That's a great deal for the banks. Not such a great deal for you. So let's look at how offset accounting can help you pay off this mortgage much faster. All right. So again, our mortgage is $250,000. And here is how we can win with this mortgage. All right. So first thing we're going to do is we're going to need a line of credit. If there's equity, it can be a home equity line of credit. If there's not enough equity, it can be a personal line of credit, but we need a line of credit. Usually we're looking for a line of credit that is 2 to 3 times what the monthly income is, okay? So for sake of this example, we're going to say that, and again, this is a perfect world example I'm doing here, that I have a line of credit of, say, $20,000. All right? And it doesn't quite work this way. This will actually charge you more interest charges, but I still want to show the dramatic difference, okay? So what I'm going to do is I'm going to make a payment of $10,000 against my mortgage, okay? So now my mortgage balance is $240,000. All right? Now, here's what's going to happen. I'm going to put in my income every month against this line of credit. We're going to work with this here again. Say $10,000. Let's say that my income is $5,000. And for the sake of this example, after I pay my bills and I pay everything that I have $833 left. Well, once I pay my bills and offset the interest here, I'm going to leave this $833, and it's going to take this balance down. And magically, over the course of 1 year, 12 months, this $833 that I'm leaving in there will pay off this balance of $10,000. So the question was, how much did this cost? All right. So again, let's say the worst case scenario possible, because you wouldn't really do it like this. You wouldn't probably pay the whole $10,000 extra in one lump sum, but for sake of example, we're going to do this to make it easy. Okay? So let's say that I had a 4% interest rate on this $10,000. That's $400. All right? To pay off this $10,000. Who would not pay $400 instead of $33,000? See what's happening here? I'm leaving this in here. I'm paying it toward the balance that I have here. Now, keep in mind, how can I do this without wrecking my budget? Again, my line of credit is double, triple, quadruple what I have in income. And if the numbers don't quite work out, you can go smaller amounts too. This is just a perfect world example. So, I have $4,000 coming in. My bills are about just under $4,200. All right. That $833 I'm leaving against the balance of my line of credit. That's going to pay off this $10,000 in 1 year. And the worst case scenario, the most interest that I could have possibly paid was $400. And I've done this in 12 months instead of 36 months. And I paid $400 in interest versus $33,000 interest. Now, you're probably saying, well, you made 12 payments. So are you including that interest? Well, technically no, and here is why. Because those payments you're making, this is the acceleration part of it, okay? Those other payments you're making, you have to make those payments regardless. So, extra, here's what's happening with the current payments you're making. Now, we talked about when you have the mortgage and you go from, it's a $1,200 payment, and you go from $300 and $900 in interest to $301 in principal, to $899 in interest, to $302 in principal, to $898 in interest. Okay? Here is the second component. The first component is you're taking large chunks, applying it against your mortgage balance, using your disposable income to pay off the line of credit, and then you're restarting the process, okay? So you're moving these into a much more favorable situation for you, and you're paying off chunks of that mortgage at a time in a very easy, comfortable fashion, not stressing out your budget, okay? So that's mechanism number one. Now we need to understand mechanism number two. It doesn't seem quite as dramatic, but it's very, very important. Here's mechanism number two. So we talked about this. Well, when you move these large sums of money, an amortization schedule, a mortgage is a very simple, almost a dumb program, okay? What it says is if you owe this balance, then this much of your payment goes towards principal, and this much of your payment goes towards interest. That's all it cares about is how much balance. It doesn't care about how much time is involved. It doesn't count the time. There's no mechanism for that. It's based simply upon balance. So here's what happens. You make this $10,000 worth payment right away. You've eliminated 3 years of payments basically from day one. And here's what else is going to happen to further continue this process. So now we've dropped our balance by $10,000, okay? It's going to take 3 years for that to catch up. But here's what happens. So let's say we change our balance by $10,000 from day one. Now let's say it's $315 going towards principal, $885 going towards interest. Well, actually, it would be more than that. If we're going off the dollar per thing, it's going to be about $330. Not quite right, but pretty close. All right, and this is going to be about $870. So now, not only are you moving large chunks over at a time and eliminate them as your disposable income can eat that up. The second thing, you're making the payments you're already making more effective in a quicker fashion. And that is simply how it works. There's no magic involved. There's nothing strange about it once you understand the mathematics. You're simply trading from a fixed loan program that's going to make you pay the maximum amount of interest to using your income to offset the interest and using it to eliminate that mortgage balance as quickly as possible. And there's probably somebody out there saying right now, well, I can just make additional monthly payments and do the same thing. I can tell you, it does not work, because think of it this way. If I tell you I'm going to pay you interest on up to $10,000, all right? You can give me $10,000 from day one, and I'm going to pay you interest on that. Will you make more if you give me $830 a month, and at the end of the year, you finally reach the $10,000? You're going to make more with it up front. That may not seem like a big difference. I actually sat down with a client to review these numbers. He was paying $700 extra a month, and so we figured out the difference. The difference was 3.5 years, or $65,000 in payments in his case. Okay, this is simply the fastest, most efficient, best way to pay off your mortgage. And if you don't still have questions, as an agent, we have some books available. If your clients have questions, we have books available, or we can sit down and explain this face to face and help them understand it. Anyway, use this product. It's great. It's fantastic. It's life changing, and don't be afraid of it. Just learn the mechanics. Thanks. Bye.